So a couple of days ago, I posted a video that discussed recession, the causes, and preventative measures. Today, let's take a deeper dive and talk about economic depressions, what causes them, and how governments try to prevent them through laws and policies. So watch until the end. Let's go through the definition first. A depression is a severe and prolonged economic downturn that leads to mass unemployment, business failures, and financial hardships. Understanding both the causes and the preventative measures can help us navigate economic challenges more effectively. Let's go through some of the causes. So, causes of depression are severe economic shocks. Events like financial crashes, wars, or pandemics can disrupt global economies. The Great Depression of the 1930s, followed by the stock market crash of 1929. Widespread bank failures. When banks collapse, people lose their savings and businesses can't get loans. Without credit, economic activity slows dramatically. Prolonged unemployment is another one. When businesses shut down or cut jobs, people have less money to spend, leading to further economic decline. Deflation spiral. Falling prices might seem good, but they cause businesses to cut wages and lay off workers, worsening the downturn. Policy failures. Poor government responses, such as raising taxes or cutting spending during a crisis, can deepen economic troubles instead of resolving them. Global trade. So, when countries impose tariffs or restrict trade, industries that rely on exports suffer, leading to widespread economic damage. Laws and policies to prevent depression are as such. So, to prevent depressions, governments have enacted laws and policies designed to stabilize the economy. Some of these measures include the Federal Reserve Act of 1913. This law created the Federal Reserve, which controls interest rates and money supply to prevent financial panics. It plays a crucial role in managing inflation and economic stability. The Glass-Steagall Act of 1933. Passed during the Great Depression, this law separated commercial and investment banking to reduce financial speculation and prevent risky banking practices that contributed to the 1929 crash. The Securities Act of 33 and the Security Exchange Act of 1934. This law regulates the stock market, requiring companies to disclose financial information to prevent fraud and protect investors. The Social Security Act of 1935. This law established unemployment insurance and retirement benefits to provide financial support during economic downturns. The Employment Act of 1946. This law was committed to provide economic growth and prevent high unemployment through federal policies. The Dodd-Frank Act of 2010, after the 2008 financial crisis, this law introduced stricter regulations on banks and financial institutions to prevent reckless lending and other financial collapse. So, few thoughts. While laws and policies can help stabilize the economy, no system is perfect. It's essential for individuals to stay informed, manage their finances wisely, and be aware of how government actions impact economic health. History has shown that when we learn from past mistakes and implement strong policies, we can reduce the risk of another depression. That said, I encourage everyone to research further and understand how these economic forces affect your daily lives.